Hello and welcome everyone to this edition of The Value Exchange from Fidelity Digital Assets. I'm your host, Chris Kuiper, Vice President of Research at Fidelity Digital Assets, and I am pleased to welcome our very special guest, Tom Lee, co-founder, managing partner, and the head of research at Fundstrat Global Advisors. We'll get to Tom in just one moment, but first, a quick introduction for those of you who may be new to what the Value Exchange is and who we are at Fidelity Digital Assets. So first of all, the Value Exchange is a regular webinar we do where we focus on a key theme or topic. It's usually coming after we have released a new research paper, and then we invite an external guest and speaker to gain their insight and knowledge and bring it to you, our listeners. So for this Value Exchange, we're here still in January. We wanted to focus on the outlook for 2025. We recently released our 2025 Look Ahead report. This is an annual report that we do. You can find it on our website, fidelitydigitalassets.com. And this is a report where our entire research team, 7 analysts now, including myself, give their perspective and some predictions. And then, of course, to discuss this paper and the outlook for 2025 in general for financial markets, especially digital assets, I don't think we could have gotten a better guest than Tom Lee. And then briefly, who or what is Fidelity Digital Assets? Fidelity Digital Assets is a subsidiary of Fidelity Investments that many of you know. So we are a separate entity dedicated to the digital asset space. Our primary products and services include custody of digital assets, usually known as cold storage, as well as a platform to buy, sell, and trade digital assets. Now, I'm not going to go through all the history that you see on this slide here. You can read it, but the point is that we've been here a very long time. We've been through multiple cycles. We've been here over a decade now. I do have a couple more housekeeping notes, but I want to bring on our guest, Tom, to introduce himself. Tom, could you tell us a little bit about yourself, your background, and what you do today?
Yes. Good morning, everybody. My name is Tom Lee. I am the founder or co-founder of Fundstrat Global Advisors. We are a research advisory firm focused on markets, financial markets, equities, digital assets. I'm also the chief investment officer of Fundstrat Capital, which is our asset management business. And we last year launched an ETF called the U.S. Large Cap Granny Shots, where I am the portfolio manager.
Excellent. And I've seen you hit some AUM records pretty quickly with that product. So congratulations on that, Tom. A few housekeeping notes. This is being recorded. So the recording will be posted publicly after the event. We put everything up on our YouTube channel at Fidelity Digital Assets. And then most important, for those of you who are taking time out of your day to join us live right now, a big thank you. And the benefit to you who are tuning in live is that you get to ask your questions. So please do. We will save at least 15 to 20 minutes or maybe even more at the end, because I know there's going to be a ton of questions, especially with what's going on in the markets today. Even though the Q&A portion will be at the end, you can ask your questions at any time. So if they come to mind and you don't want to forget it, hit that Q&A button at the bottom of the Zoom screen, type it in there. Nobody else, none of the other participants or listeners will see the question. And you even have the option to check the anonymous box, so you can ask the questions without even us or our team seeing your name. So we want to have a very candid conversation. So again, hit that Q&A button at any time, enter your questions, and we'll start to filter them and bring some of them up at the end. And then really just a quick plug, we do have a survey at the end. So when you close out the Zoom screen, it should pop up, or you may get an email afterwards. It literally only takes 30 seconds to do. Please do it. It helps us immensely. And it helps you in that we can tailor the information to you and what you want to hear going forward for these. All right, so enough talking for me. Tom, let's get to you. I'm going to hand it over for you to set the stage here. 2024, another great year, second year in a row, back-to-back, very positive, strong gains for the market, obviously strong gains for Bitcoin. But now in 2025, we've got quite a bit of volatility coming back, certainly over the last week, and then especially yesterday. How are you viewing 2025? And has anything in the past 24 hours or week changed your mind? Has anything changed in your outlook? Is one of the things I think a lot of people are dying to know.
Thank you, Chris. For many folks who are here, I am sure you own stocks and digital assets. And 2024 was a year where the S&P gained over 20%, but it was a year where many folks had warned investors to be cautious because they either expected a recession with the inverted yield curve, and many had guaranteed us a recession really for the last few years, or that the Fed needed to engineer some sort of recession to kill inflation, or that the election in the fall was going to cause the stock market to crash. Those are what I would call classic walls of worry, and markets tend to climb a wall of worry. As we entered 2025, our view for our clients was that we were constructive for 2025, and that's even in the face of the fact that the S&P had posted 2 back-to-back gains of 20%. And the reasons we were positive really reflected a few things. One is we thought that the macro environment was going to be very favorable. The Fed is in an easing cycle, even though we don't know how much the Fed's going to cut. That is dovish for stocks. The second is that this incoming administration is the most pro-business administration we've had for several generations, and it is a big contrast to the last 4 years, where businesses, I think, were dealing with a growth in regulation and regulatory cost. That should be reflected in the ISM Manufacturing Index, which has been below 50 for 26 months, to finally move back above 50. The ISM survey has been around for 70 years, and many people may not be too familiar with it, but it's been a way to speak to purchasing managers. And when this index is above 50, that means overall business activity is rising. It's been below 50 for more than 2.5 years. That is highly correlated to earnings growth. So I think S&P earnings will actually surprise to the upside in 2025. And the third thing that I think is quite positive for this year is that there is already skepticism about what equities can do. And that's because we already had 2 back-to-back 20% years. And on slide 5, which I'd sent to the Fidelity team, shows you the 6 precedent instances where the markets had back-to-back gains of 20%. Couple things stand out. One is that the first half of the markets tend to do better than the second half. That's what this slide shows. But I think the bigger takeaway we had when we looked at 2 back-to-back years of 20% was you have to put context into the year before you had back-to-back gains of 20%. The S&P fell 20% in 2022. So even though 2023 and 2024 were good years, the cumulative gain for the S&P was only 27%, which is a compounded gain of 7% a year. Those 6 precedents that I'm highlighting here had a compounded annual gain of close to 20%. So what does that mean? The S&P entering 2025 is coming off 3 years where the gain was below long-term average. I think that that's the reason why stocks will probably surprise to the upside this year. And just to wrap up, since our early December publication of our 2025 outlook, there have been a few data points, right? Because we're actually 6 weeks past that point. And I think 2025 is actually tracking better than expected. The first is we didn't get the tariffs and the tariff wars that many investors feared, and that was causing inflation expectations to go up and also actually causing dollar strength. Instead, the dollar has actually started to roll over and interest rates have actually backed down. And oddly, Fed fund futures still have a 27% chance that the Fed is going to raise rates this year. So I think there's still plenty of skepticism. The second thing that's, I think, very constructive is that there are 2 windows to watch to give us clues about the full year performance. It's how markets perform on the first 5 days of the year and how markets perform for the month of January. But if we can jump to slide 7, this shows you the importance of watching those first 5 days of the year. And if the first 5 days were positive, and in fact, in 2025, the first 5 days, we saw market gain 0.6%. Since 1950, there are 41 instances where the market in the prior year had gained 10%. And if the first 5 days are positive, that's 28 instances, the median gain is 13%, and the win ratio or positivity is 82%. If we had been down in the first 5 days, the median gain is -3%, and the odds of a full year gain is only 54%. So the January first 5 days was positive. And as long as we close above 58, 81, 83 by Friday, that is what we call the January barometer. But how January goes, so goes the year. So if January closes positive, the odds of a positive year actually jump to close to 89% with a median gain of around 19%. So so far, so good, I'd say. I mean, just as a quick backdrop.
No, that's excellent. Staying on macro for a minute here, I will throw out a wall of worry. One of the things I wrote in our report was, why is nobody talking about the possibility of stagflation? And to be very clear, this is not a prediction. It's not even what I would call a base case scenario, but I think good investors always look at all ranges of possibilities and assign probabilities to them. And I just found it odd. We started drafting this back in last Thanksgiving. I just found it odd that with inflation still high, staying sticky, seeming to maybe even turn up or accelerate, that you have one leg of that stagflation. And then if anything were to happen to the growth story, you could get a stagflation scenario. So curious to hear your thoughts on that. I mean, since then, we've had more data points. The core CPI did surprise to the lower end. We got it down to 3.2. That's still very far from 2%. The PCE core is more interesting to me. 1 month annualized is at 3.5%. And it's turning up. And then the ISM services, which you mentioned, the prices paid, is also turning higher. So curious if this is in your realm of possibilities, or if this is just another one of the walls of worries or buckets of skepticism that you just mentioned.
Inflation is very hard to forecast and predict. The Fed made several attempts to try to look at inflation a couple quarters ahead, and as you know, they've kind of given up because Fed Chair Powell himself just says their forecasts haven't really worked. Because of that, markets are very data point sensitive. And as you're pointing out, Chris, inflation has risen the last couple of months, especially core, and it's raising worries about a second wave of inflation. That's why Fed futures actually has a 27% chance of a Fed hike this year. I think markets are pricing in 1 in 3 chance of stagflation that you're pointing out. But if you asked me my opinion, I think that's all a head fake for a couple of reasons. First, just in the data, and the Fed has noted this, in 2024, almost all of the rise in inflation in 2024 is what's called imputed inflation. What does imputed inflation mean? It means the CPI index was rising because they're trying to have things like shelter and car prices or insurance catch up to market levels. Why do we know that that was imputed? Well, there's a lot of easy ways to calculate, and the Fed even in their method, the BLS in their methodology clearly explains it. Shelter inflation lags actual market prices because they have this concept of having inflation reflect the overall base of housing. So if home prices rose, and they rose really sharply during the pandemic, they don't introduce that inflation in 1 year. It's introduced over time. Shelter has accounted for more than 70% of all inflation since 2019. The second largest contributor is auto insurance and used cars. Together, those are over 90% of the rise in inflation since the pandemic. You might think, what about food? Well, unfortunately, food is not included in core CPI, but everything else, healthcare, electricity, travel, all that is a small contributor to overall inflation. In 2025, we already see the leading indicators of these rolling over. The BLS just released what they call the new tenant rent index, which is a leading indicator for shelter. That's gone negative. auto insurance has actually reached what we call sufficiency. Progressive is reporting tomorrow morning. We should see that auto insurance premiums are no longer rising at 26%. They've cooled off, and used car prices are actually declining now. So unless there is a new source of a supply chain shock, uh, I would be surprised if inflation is going to rise. And there's many contemporaneous measures, whether you can look at trueflation, which has been stable, or the TIPS markets, it's actually been pretty stable, or 1 year inflation forwards, they don't show inflation. So I'd say the market's pricing in stagflation fears, but if they were correct, we should not be having a cyclical rally. And this year, the cyclicals are leading.
Got it. Very interesting. And I really like your in-depth analysis of digging into what actually makes up inflation. I know a lot of people that follow you, you constantly talk about your evidence-based investing. I think this is a good example of that. So I want to transition from macro to Bitcoin first here. And on that note of evidence-based investing and your philosophy and your framework, you were one of the very early and few analysts on Wall Street to not only start covering and talking about Bitcoin, but also making some very bullish calls that consequently turned out to be very correct. I'm curious, always in this space because it's so new. Uh, what's your origin story? How did you get exposed to Bitcoin? Where did you first hear about it? And then what led you to those calls?
First heard about Bitcoin around 2012. I was the strategist at JP Morgan. And in our weekly macro calls, Bitcoin had become a topic of conversation among our FX teams, and that was headed by John Norman, because he thought at the time, and Bitcoin's network value was about 10 billion, so it was quite small. But he thought it over time, it actually could be viewed as a currency. And so the JP Morgan macro team, believe it or not, had many discussions around Bitcoin because of its stratospheric rise. But at that time, there were many questions about the legitimacy of Bitcoin because, and I think the data had actually proven itself out that more than 60% of the usage of on-chain volume at that time was really for dark web usage. I didn't think much about Bitcoin subsequently, and then I started Fundstrat in 2014, and we created the firm to be a evidence-based research firm, but really taking that evidence-based institutional research and essentially democratizing it, making it available to a wider audience. And while at Fundstrat, I ended up looking at Bitcoin's price. I hadn't thought about it for years, and then I saw that it had risen by a factor of 10. And this is what I've known. I was a technology analyst starting in 1993, and I was originally a wireless analyst. I covered the industry from when there were 34 million cell phone users until 2007, when it reached over 4 billion. So I witnessed a hyper-growth industry. And one thing I realized was two things. One was nobody ever believed that wireless growth would ever get as big as it did, because at the time, cellular penetration was not even 1%. Today, it's 100%. Most people didn't think it would ever exceed 30% of the population because they couldn't imagine grandmothers or children ever using a cell phone. But I realized when I was in my 20s doing that work is that cell phones drastically transformed how people used communication. Like, as a young person, you don't have to leave messages on an answering machine and use payphones. You could actually just call people directly. So I saw this through my young eyes as a place where cellular was going to be quite big. And so we decided to say, look, whenever something goes from 10 billion to 100 billion of network value, you can't consider it a bubble. So we decided to really dig in and try to understand what was happening. And what we found was that Bitcoin's price from 2010 to 2016 was 93% explained by just two variables: the number of unique addresses, and by 2016 it was, over 400 million roughly. But really, in terms of wallets, it was much smaller, and because many people have multiple wallets. And it was the second variable was just the activity per wallet. And that explained over 90% of the rise of Bitcoin. So then we realized crypto was just a network value asset. And the more work we did, we realized that blockchain, of course, was a really important solution to creating trust and really bulletproof trust between two parties. It was actually kind of a reworking of the financial system. So we were quite bullish on Bitcoin. In our first white paper we published, we had proposed that Bitcoin was around $1,000, that within 5 years it could get to 25,000 because we only simply had to see the number of wallets increase by 40% a year and the activity per wallet increased by 20%. And 5 years after publication, Bitcoin was around 22,000. So of course, Bitcoin continues to actually follow what I consider to be network value properties.
Excellent, excellent. So a similar story to me. I found Bitcoin in 2012. I was a tech stock analyst covering tech hardware companies. And I thought of it as a technology play, and I had this technology lens. But then my thinking changed as viewing it as this monetary asset. And people have seen our reports, Bitcoin First, our most popular report out there on viewing Bitcoin as this aspiring form of money, store of value. How do you view it today? Is it still more in the technology realm for you? What's your framework for viewing this? You mentioned it's still following that model still. If so, do you have any updates on that model of where you think this goes and if or it does track or doesn't track that in the future?
Well, actually, we've updated that model. The coefficients change because Bitcoin's the way it's held, especially growth of exchanges and the ability to short, have changed. But even with adjusted coefficients, I believe our latest calculation is 80% of the move in the last 7 years is explained by just those two variables. I think Bitcoin's upside is arguably somewhat unbounded for a couple of reasons. One is, in an increasingly digital world, and over 50% of all global GDP in the last 10 years came from digital growth, it is going to raise the question why we have regional money. I mean, it's a strange concept, but if most of the economy is creating value, why do we charge different prices in Ireland and the US for the same piece of software? So you do want to have, a sort of unit of value that's clean and digital. And of course, in an increasingly digital world, it's really hard to have trust. And Bitcoin is still the only blockchain that has never had a fraudulent entry. And that compares to a fiat financial system that usually has an oracle where, JP Morgan's latest earnings report, not only is 6% of all their financial activity labeled suspicious, that number is growing despite all that increase in cybersecurity. So I think that there's a lot of ways to think of Bitcoin's upside in simplistic ways, because not everybody wants to do a model and project future growth rates. The first is really thinking of Bitcoin as a replacement for gold, as digital gold. And there is a slide, page 9. Gold's network value is 20 trillion. And by the way, gold is actually not even that scarce, because gold is not only is mined from the ground, but I think less than 1% of all gold has actually been extracted. So the earth contains a huge amount of untapped gold. But on top of that, I visited the Australian Mint several years ago, and I learned that almost all the gold on the earth was actually a result of extraterrestrial impacts. So the universe has a plentiful supply of gold. If Bitcoin were to replace gold, the next slide shows that you would get to a network value for Bitcoin of 950,000 per Bitcoin. But gold supply is increasing roughly 2 to 3% a year, and the price of gold is actually rising. So I would say the minimum displacement, if you were just looking at gold as a substitute, Bitcoin should be roughly 1 million, and that's more than a 10 times increase from here.
Yeah, one of the things I like to point out to people is depending on how you think about the correlation of Bitcoin to gold and other assets, if gold is moving on some of the same macroeconomic factors, whether that's inflation or whatever it may be, Bitcoin could keep its same percentage of the market cap of gold and still move up as well. Both can move up. So that leads me to my next question. How do you view Bitcoin in comparison to other asset classes like gold or even other real assets or traditional assets like stocks, bonds, commodities? How do you look at their correlations? Do you think they continue to be fairly low correlated? We've seen times when some of these are highly correlated, especially Bitcoin to tech stocks. Thoughts there, and how do you think investors should think about this in terms of potentially incorporating Bitcoin into their portfolio from a portfolio construction perspective?
Sean Farrell is our digital asset strategist, and he did do an optimization calculation. And all that means in simple terms is knowing how much Bitcoin moves up and down, and sometimes it moves in relation to what stocks do or bonds or gold, but sometimes it moves completely separately. So taking that correlation into account, along with how much volatility has, how much it jumps up and down versus the others, his optimization curve is that you should own more than 20% of your net worth into Bitcoin, because it provides a lot of ballast or protection to your portfolio, along with, of course, upside potential. Now, that's a huge ask for people. So we've only recommended originally a 1 to 2% allocation, now in our 8th year of recommending Bitcoin. And we've heard from our clients how much it has actually protected their portfolios. Because for some folks who put that 1% into Ethereum, that is now 80% of their net worth. Today we recommend investors put roughly 5% of their net worth into Bitcoin. And the reason for that, of course, some of that is at the expense of reducing your investment in alternatives or reducing your investment in gold. But I think 5% is actually a good starter allocation. The reason I think it's arguably reasonable is that most people could lose 5% on an investment, and they won't have a catastrophe. But if that 5% achieves the price levels we expect, that could easily become 50 or 60% of your net worth. So it is a small bet to make on something that could provide a lot of upside over the next few years.
Yeah, absolutely. That asymmetry is key. And I think that's also key for people to realize and frame it that way of, look, even if this thing absolutely goes to zero, you do have a very specific bounded loss, and you can make that whatever you're comfortable with. But we've seen what the potential upside can be. And of course, you're talking about people who let the position run. And then, of course, there's another strategy for people who are more risk averse. They can continue to rebalance and pare that back, right? And we've found in our research that there's a lot of good benefits with that as well. You actually can outperform because Bitcoin uniquely has more positive returns. The skew is to the right in terms of looking at a histogram of its returns. So you're actually harvesting that upside and that volatility, which I think is very interesting. With your experience on Wall Street, I'm interested because Bitcoin has arguably been unique in that a lot of retail adopted it before Wall Street, and they still arguably can. What do you think is the greatest barrier to Bitcoin adoption on Wall Street or perhaps otherwise? And conversely, what would be one of the biggest catalysts to move this adoption forward?
There are a lot of psychological obstacles for why Wall Street hasn't adopted Bitcoin in a larger way, and regulatory. I'm not going to walk through these in any particular order, but when we first started looking at Bitcoin, we were met with tremendous backlash. Our firm at the time was basically 99% institutional. So our business was purely with hedge funds and asset managers. And they were angry at us for a couple of reasons. One is that Bitcoin had a tainted reputation in their minds that it was only used for drug dealing and dark web and people who want to avoid taxes. That has statistically been proven to have completely flipped. Whether you look at on-chain analytics, but over 95% of all Bitcoin activity is pretty legitimate movements of money. And the second is many people can't get over the idea that Bitcoin is based on what they call nothing. And what they mean by that is they can't get their arms around the idea that Bitcoin is based purely on trust and the cost of actually in maintaining that trust, which is the block reward. And that's what makes Bitcoin expensive, is because you're doing this huge computational hash that's very expensive and it's protecting the blockchain. But then these same folks who actually say they cannot own something that has no value gladly trade credit default swaps, which are gambling bets on the creditworthiness of a bond. Most people think the bond market is this gigantic machine that is based on people buying and trading actual bonds of different companies and governments. That's not true. Most movement and trading of bonds takes place at another level, which are essentially derivative exposures of the underlying bonds. It is over 100 times the actual trading. Cash bonds barely trade anymore. And then someone say, well, the dollar, of course, is backed by the government. So why would you even want to own something that has no protection? Well, first of all, keep in mind, for every dollar that's used for US GDP, which is about a $30 trillion economy, the US dollar is traded almost 1,000 times as speculation on price. So the dollar is a huge speculative instrument. And will someone say, well, oil is a true commodity because you buy it and then you use it at the pump. So if Bitcoin's a commodity, oil is anchored. Well, reality is 80% of all oil is bought by refiners and then it's turned into gasoline. If you look at oil trading on futures markets, that is over 400 times the amount of activity on actual reserves. So almost everything that can trade on a digital exchange is now an instrument of speculation. So that's crypto. I don't think it's anything different, except you're actually trading trust. The third reason people don't like Bitcoin, and sorry for this long-winded answer, is that other people got rich and they can't stand it. And that is probably one of the biggest arguments. I can't tell you how many fund managers said that they were enraged that their son bought Bitcoin and made a few $1,000,000, or their neighbor suddenly paid off all their debts and mortgages and they got fantastically rich because they bought Bitcoin in 2010. It makes people so mad. It reminds me of how people hated Netflix because they said it was a dumb retail stock, or people could not stand Tesla. They said Tesla is the biggest cult stock they've ever met. In fact, if you look at all the stocks that have done really well today, they've all been stocks that retail discovered and now institutions understand are actually good companies, whether it's Palantir or NVIDIA NVIDIA had institutional backing. And then finally, of course, there's regulations because, as you know, governments have been pretty hostile to Bitcoin and actually for the last few years even tried to essentially restrict its ownership in the US. And the banking system views it as a huge threat itself. So I think the financial industry itself has to come to grips with that. Bitcoin is an important way to re-engineer the financial system, but it's a threat to a lot of parts of it.
Yeah, absolutely. All right, I do want to get to other digital assets besides Bitcoin, but one more on Bitcoin. What do you see as the greatest risk? We released a report where we go through a lot of the what we think are not actual risks that are commonly cited, but then we add a few things that we truly do think investors need to consider as non-zero probability chances of happening, true risk, things that actually keep me up at night. I'm curious, what keeps you up at night about Bitcoin? What do you think are the true risks that investors need to be aware of?
Well, there's the known issues that people talk about, whether it's quantum, et cetera. But if you ask me what I consider the risks that could cause a 50% decline in Bitcoin's price, or network value, it is a couple of things. One is, that some thing or some type of computing can break the cryptographic hash of your private key. So not necessarily the blockchain, but suddenly your wallets aren't safe. Because then we'd have to figure out actually how to hold Bitcoin safely. And that's something that's not that widely discussed. The second is that Bitcoin is now increasingly held through intermediary parties, whether it's ETFs or leveraged Bitcoin holdings through companies like MicroStrategy that are using novel strategies. And that is pushing the custody risk to a third party. So in other words, even though we know it's not necessarily the greatest idea for people to store their own Bitcoin because it's a bearer asset, and unless someone's really good at securing that bearer asset, they do face risk of loss. If it's held by a third party, as you know, William Sutton said it's the reason he robs banks is that's where the money is. So I think that you have more vectors of attack of actually the custody of Bitcoin. So instead of the blockchain breaking, you could actually face loss anyways. And I think that the third risk that I don't think we have to worry about in the near term is that I think by the time we get to 2140, the year 2140, when in theory the block reward is going to get so minuscule, it is going to be a somewhat existential question about whether or not Bitcoin has to fork at that time. And how that will fork, because the entities that are going to be involved with Bitcoin will be very different.
Yeah, that's interesting. I would add also that a lot of these risks, I would agree with, and people point them out, but then they stop there. They don't think of the response of the Bitcoin holders or the community or anything like that. And so some of these, while they're real, I think you have to think through the full potential of how people would respond, and especially with like quantum computing. The security budget one, the third one you mentioned, is an interesting one, and one we've talked about before. And in our 2025 look ahead, one of our analysts points out that maybe in the future, there's a future where miners don't need the block subsidy to be incentivized. Perhaps miners are purely doing it for the heat generation first and foremost, and then the transaction fees and the minuscule blocks of subsidy are just a nice bonus, an offsetting cost. Or perhaps in the future, certain entities like custodians or others, they'll choose to mine Bitcoin just as the pure incentive of keeping the network secure and distributed. And they'll just consider it a cost, and they don't even care if they're not making money like the miners are currently today. So we'll definitely see how that plays out. All right, moving to the other digital assets, we got a number of questions on X, asking for people's questions for this webinar on XRP. And of course, that one's very timely. It's moved up to the third largest cryptocurrency or token. Very curious, given your experience at big banks like JP Morgan, do you see a use case for XRP? Are banks actually using this in scale or size, or should people be thinking of this in another way?
Well, XRP is one of the longstanding tokens, and I think its rise has really caught many folks by surprise. The reason for the controversy is several, but in short, it's really because the supply of XRP has essentially been pre-mined, and it's really controlled by a couple of entities. Um, I think banks will actually not be loyal to any technology when they're testing a platform. So someone should keep in mind that if someone thinks that there is something that's going to be the backbone of the new banking system, that's really not how banks work. In fact, banks will actually use something, and they over time may want to adopt something or even build products around something where they believe they can make a lot of money. I think it's actually far more likely that banks will end up using a lot of Bitcoin. If you ask me in 10 years, who's going to make the most money trading and custodying and building products around Bitcoin, it probably will be JP Morgan and Goldman Sachs. they have never met anything with volatility that they haven't loved. Volatility is basically how banks step in and make a lot of money. And if they have the green light to it and they can get over the institutional bias, that is the equivalent of basically, you know, getting rid of the combustion engine. And as we know in that automotive world, you know, electric cars really are the future.
All right, let's get to the Q&A portion. While we're assembling those questions, I'll sneak one little one in here. The rise of meme coins. What do you make of it? Is this a net negative? Are there parallels to what you've seen on Wall Street with meme stocks preceding these? Or is this, you know, on the other end, some people are saying this is a positive. It's a gateway to bring people into this space. And do you see them making their way over to something like Bitcoin after getting in through the meme coin frenzies?
Um, I mean, the meme coins are really amazing to watch, especially something like the Trump coin has gotten to a huge network value, fully diluted over $30 billion. I think it's really an example of crypto experimenting, and I think it's extremely healthy. Why shouldn't we see what I'd call market-based pricing for an idea or an asset is? I think that's what meme coins are. They're saying that the Trump brand is incredibly valuable, and I suppose if someone were to make a market for all meme coins, we don't have to do brand research anymore. Like, you don't have to know what Procter and Gamble's brand is worth because there might be a meme coin for it. Wall Street has also experimented with stocks and structures that are similar to meme coins. To me, SPACs and BDCs are meme coins, you know, because a SPAC is literally a shell company and it has value because someone thinks that the manager is going to actually build assets. A hedge fund formation is a meme coin in theory because you're giving some guy money and then you're asking him to do something with it. Of course, he's going to be, you know, there's reasons to have trust in that process, but capital formation is essentially not that different than a meme coin at the core. So I don't think it's actually, I don't think meme coins are really the end product anyways. I think they're going to be experiments and then figure out if there's ecosystem to build around it. Because if someone adopts one of these meme coins as a way to create a reward system, then you actually have a genuine economy built around it.
All right, excellent. Casey, let's get to some of our questions here. What do we have first?
Yeah, so the first question, a couple people wrote in about this, had some questions on expanding a little bit more on both of your point of view on Ethereum and Solana and the narrative surrounding the two of those, you know, beyond Bitcoin.
Yeah, I'll quickly say again, look at our 2025 look ahead report. Our analyst Max covers Ethereum, and he's been in the camp that their roadmap has stayed the same. Nothing has changed. They continue to focus on layer twos, this roll-up centric way of optimizing the network. And that comes at the cost of some fees on the base layer, although it's not as bad. And he shows us with some charts as what people think that there's still demand for the base layer. But that's the long-term plan. And so they're willing to give that up in the short term for the long-term gain of more network effects, more users, more building. But Tom, I don't know if you see this differently. I know you cover Ethereum and Solana a little bit as well in your research.
Those Ethereum, Solana, and Bitcoin are the three that our digital assets teams does spend the most time studying. They're not as constructive on Ethereum because I think that they do think that there is some effects from the leadership from the foundation that have actually made Ethereum a little less dynamic and interesting to them and a place where innovation might take place. They actually are a lot more constructive on Solana, which they think has, well, one has some feature improvements over Ethereum, but I think has a community that is actually showing quite a lot of innovation. And I think the fact that some of the bigger meme coins, for instance, have been launched on Solana, and the transaction speeds have been increasing, have made them view Solana as a better alternative. And I think Sean Farrell himself thinks Solana itself could reach close to 500 this year.
All right, excellent. Next one, Casey.
Someone had a question around diving a little bit deeper on how you're valuing digital assets. So what are the types of data that you're looking at? So Chris, I don't know if it's worth mentioning our signals report and just kind of the way we view like traditional versus, the newer on-chain metrics that might be worth chatting about.
Yeah, so when you're talking about looking at these assets, you have traditional price metrics, but you don't have fundamental company metrics like traditional equities and other things. But you do have a whole new set of data called on-chain metrics. So this is the data that's created because these are open ledgers and you can see everything. So we put out a quarterly signals report, and it's really geared towards the investor who's maybe only checking on their portfolio or position every quarter. It's not meant as any kind of trading or recommendation advice, but it's to check in on these different time frames. And you really have to match the on-chain signal to the correct time frame, whether you're looking at a year or less, you're looking at the midterm cycle, 1 to 4 or 5 years, and then the long-term fundamentals. And so for an example, long-term fundamentals would be, is the network growing? Are addresses growing, like what Tom talked about? Is activity growing? To me, that's like the fundamentals of a company of is the company still growing? And so that would, for example, be for someone who's wondering, is my long-term thesis intact? And then other signals such as the medium term, we look at more of the cycle. Where are we at in the cycle? And there's a number of ones you can look at. And by the way, this is a free PDF. It's an interactive PDF, so you can start at the top level and just get the assessment or the rating, and then you can click into every single metric, and we explain what the metric is, what it's saying, how we're interpreting it. So that's one bucket. And then the other bucket is more of, how do you value it? And that's what Tom and I have talked about more on this call, which is comparing it to other assets like gold. How much do you think it could take of that? Or building a model based on something like active addresses. For example, we have 2 research reports. One's called Valuing Bitcoin, where we go through those demand side models. We look at it similar to how Tom recognized it with cell phones. We compare it to the rise of the internet. And so if Bitcoin were to follow the same path as a network effect market, what could it look like in terms of its adoption? So those would be the main things I would point out there. And unless Tom has something to add, we'll maybe go to another question and see if we can get in as many as we can with the last 5 minutes.
Okay, yeah. The next one is around just what you both think are like the biggest tailwinds behind digital assets moving forward, or maybe just what you're most excited about, over the next few years to come.
Yeah, I'll quickly say, and Tom's mentioned a few of these already, but we've been wanting regulatory clarity. We seem to be getting some of that. We'll continue to work for that. And then I think it's really interesting that if you zoom out and you were to say, what are some of the mile markers you would see if an asset were being adopted? And you would have, even just a decade ago, you'd say, well, people would hold it, maybe companies would hold it, maybe even countries would hold it on their balance sheet. Maybe it'd start to be talked about in the political arena. And nobody would have believed all these things would have happened 10 plus years ago. And of course, we've hit all of those. And I think the only constituent left that hasn't specifically bought it yet is central banks. We have had at least one country and a couple smaller other ones put it on their treasury. And then, of course, the next step is, do we just see more of the same? But of course, the first one to do it is always the hardest. And then we could see additional adoption. And so those would be the things I'm looking at, those big institutional adoption markers of more and more people doing it. And then the last kind of holdouts of these different groups or subgroups. We haven't seen a lot on the big institutional money yet, things like pensions, endowments, foundations. If that happens, that would be another big tailwind or marker that I would be looking for.
I think that was a great answer, Chris. I wouldn't add to it.
Great. Okay, another question we have is just kind of what's your overall outlook on the industry that seems to be developing around this intersection of public equities and digital assets and these companies that are starting to intersect? If either of you want to give a point of view on that.
I'll definitely turn that one over to Tom. That's in his wheelhouse.
Yeah, the question probably relates to several types of companies, and there are public equities, ways to get exposure to Bitcoin. There are the ETFs. There are the exchanges, and there are miners, and there are also companies that I guess I would coin as following the Bitcoin standard or leveraged exposure to Bitcoin. And really the leading edge of that is MicroStrategy. Of those, I think the most novel is the approach taken by MicroStrategy. I actually think it's an incredibly smart way for someone to get exposure to Bitcoin for a couple of reasons. MicroStrategy, if you're not too familiar with it, is using Bitcoin as basically a balance sheet asset. They were a former security company, but since 2019 really has raised capital and built its entire equity value around acquiring Bitcoin and funding it at a reasonable cost. The reason I think the strategy works, and it's probably not enough time on this call, but they're taking advantage of the volatility of Bitcoin to borrow debt securities. And these debt instruments, which are both convertible and straight bonds, have been very good performers for bond investors because you're getting essentially a free option because of the volatility offered by Bitcoin. What does that mean? It means that MicroStrategy is funding its purchase of Bitcoin at way below cost of capital. So if you believe Bitcoin is going to go to 1 million, MicroStrategy is going to give you a leveraged way to own Bitcoin and with more upside than the traditional price of Bitcoin rising. So I actually think these are great strategies. Similar Scientific is following the same strategy, and it's been very successful for them as well.
Right. We are unfortunately approaching the end of the hour here. Tom, where can everyone go to follow you, your work, and learn more about your work?
There's several ways to find us. If you want to go to our website, there are 2 websites to check out. One is fsinsight.com. That's Fundstrat Insight, fsinsight.com. And you can find our research services there. If you want to learn more about our ETF, Granny Shots, it's at grannyshots.com. And of course, if you are just a social media user, you can find us on Twitter or x.com. That's really where we are. So we're not on Telegram and we're not on WhatsApp. Do not look for us there. Only on x.com. And that is, our handle is @Fundstrat.
Excellent. Well, thank you, Tom, for your time today. This has been excellent. And thank you all for tuning in and staying through the full hour. Just a quick reminder of that short survey. And otherwise, we hope to see you again next time.